Hi everyone, welcome to Anu's classroom. Today we will be discussing all the important questions and answers of MMPC 4, that is accounting for managers. So I know this subject it is a bit difficult for most of us, right? Especially people from the non-commerce background. So I thought rather than simply brushing through the important concepts like we did for the other subjects, what I thought is we will discuss a little bit in depth on each of the concepts that are coming up, okay, along with our question answer discussion. Okay, so this session is going to be a little bit long. We will divide it into parts. Okay, I have collected around previous 5 to 6 years question papers, 5 to 6 terms question papers I have collected, so we will be discussing all those questions. So what you need to understand, as we all know, this is a practical paper, it is a mathematical paper, but don't worry, as per how term and examination it is formatted is that we'll have at least 8 questions, out of which we only need to answer 5 of them. So in total you will get 8 choices, of which you need to attempt only 5. So the general pattern that we have been observing so far is that of the 8, 1 or maximum 2, okay, definitely one will be there, or a maximum of 2 problem or the mathematical question will be there, and the remaining will all be theory. Okay, so if you know the concepts that are discussed in MMPC 4, even though you do not understand how to prepare the trial balance or the balance sheet or a profit and loss account or cash flow or whatever that is, okay, if you do not know also, it is fine, you will not fail, do not worry. So in case you are from non-commerce background and you do not know how to prepare these statements or the mathematical part of it, the accounting part of it, do not worry, don't stress about it. Make sure that you know the concepts well. Okay, all the concepts, all the concepts that are discussed in MMPC 4, if you know that very well, you will get very good marks. Okay, as I had said earlier while we were taking our MMPC 4 classes also, I said, right, as MBA graduates, as future managers, what is expected out of you is the financial literacy or the accounting literacy enough to read and understand the financial statements. You will not be in charge of preparing them unless you are going for MBA finance, which I strongly suggest you do only if you like this kind of things, or if you are somebody from the commerce background and you like finance and stuff, then only take up that. Otherwise it's not just about studying, right, it's also about working in that field, which matters. Okay, so let us get started without wasting much time. Okay, so the first question we have is, explain the basic structure of cash flow statement and the meaning of cash and cash equivalents. And they're asking to discuss in detail the type of activities that are taken into consideration while we prepare cash flow statements. Again, we had in another year a similar question related to cash flow statements, which again asked for the activities that are taken into consideration while preparing it. What are the direct and indirect methods for preparing cash flow statements, and to highlight the main difference between the direct and indirect methods of cash flow. So we had I had uploaded a detailed video on cash flow statements, all the various components, its advantages, disadvantages, where it is used, all those things in detail. Okay, so I will leave a link to either the video or the MMPC 4's playlist, which has all the topics we have discussed so far. Okay, so for in-depth knowledge, you can always go and refer there. So from this question point of view, what do we know about cash flow statements? Okay, what is a cash flow statements? We know that there are 3 main or important financial statements which are prepared at the end of every financial year, right? Those are we had the balance sheet, then we have the income statement, and we have the cash flow statement, right? And the cash flow statement, it is prepared in the by taking into consideration both your balance sheet and the income statement. That is the indirect method of preparing cash flow statements, right? So what is a cash flow statement? Actually, it is a financial report, right? It deals with it details how the cash flow, right? The name itself is indicating of that. It is describing or detailing how cash entered and left the business during that particular financial period, right? Now, what is the purpose of this cash flow? It is to provide a more detailed picture of what happened to the business's cash during that accounting period, right? Now, in a typical cash flow statement, we have 3 components or 3 sections. Okay, those are the 3 activities which we actually take into consideration while we prepare this cash flow statement. We have cash flow due to operating activities. Then we have cash flow from investing activities, and we have cash flow from financing activities. So operational activities, investing activities, and financial activities. If you take a cash flow statement and see, you will have details regarding these three activities which involved cash. Okay. Now, what are cash and cash equivalents? Cash, we all know, it is the liquid money which we have, like cash, actual money, currency notes or coins that we have. What are cash equivalents? Cash equivalents are the company's assets that can be converted into cash immediately. Okay, like our bank accounts or some marketable securities such as commercial papers or short-term government bonds and all. Generally, they should have at least a maturity periods of 3 months or less. Okay, 90 days or less is the general guideline for considering a bond or a commercial paper to be a cash equivalent. The main aim is that even they they should be able to be liquidated into cash very easily. Like for example, if you have a bank account and there is money, anytime you can go and withdraw the money and get it, right? You get the cash. So that is a cash equivalent. Similarly, if you can do that with your commercial paper or a government bond or whatever that is, or a treasury bill and all, then it is a cash equivalent. I hope you understood what is cash and what is cash equivalent. Now, we said that the typical cash flow statement comprises of the cash flow sections like cash flow from operating activities, investment activities, and financial activities, right? Now, what is the direct and indirect methods of preparing cash flow statement, right? And the main differences. So, this direct and indirect methods, there are two different methods that are used for the preparation of cash flow statements from companies, right? And the main difference between these two is how cash flow in the operating activities part is handled. Okay, so that is the main difference between how we prepare the direct and indirect cash flow. Okay, so in the direct cash flow method, changes in cash receipt and cash payments and all are reported in cash flows from operating activities section. But in case of indirect cash flow, the changes in assets and liability accounts, they are adjusted in the net income, and it will be used to arrive at the cash flow from the operating activities. So direct methods, we actually what we do is we directly write down what all happened, how cash flow. But in the indirect method, actually what we do is we take into account our balance sheet and income statement, and from there we try to find out what are the changes that happen in the assets and liabilities, and we adjust it into the net income from the income statement, and then write that as a cash flow in the operating activities. Okay, so that is the major difference that you can see between your direct and indirect method of preparing cash flow statement. So what happens is that in the indirect method, the cash flow statement actually acts as a reconciliation tool for your balance and income statements as well. So in case there is some issue in how the balance sheet or the income statement was prepared, we will easily catch it when we prepare the cash flow statement. Okay. So some of the major differences you can say is that in the indirect method, it uses net income as the base, and it makes necessary adjustments like adding or subtracting variables to convert the total net income to cash from the operation. But in direct method, what happens is that cash being received from customers and cash being paid to suppliers or employees and others are directly written down in the operating activities. Same way, direct cash flow method, it starts with cash transactions like cash received, cash paid and all, while it ignores the non-cash transactions. But in indirect cash flow method, calculation actually starts from the net income, and then we go on by adjusting the rest of the things. Okay, so that is regarding cash flow statements. In case you have not gone through cash flow statements, please go through it. It is important. It has come as assignment questions as well, so you can expect a question on cash flow. I think almost all the term and examination papers that I went through, at least some question was there related to cash flow. These questions itself had come up multiple papers. I just took the unique ones and kept. So cash flow is very important. Please look at it. Next question, what do you understand by absorption and marginal costing? Bring out the major differences among them and discuss the utility, that is advantages and applications and limitations of marginal costing. Again, a similar question which has come up on marginal costing is, to explain briefly what are the techniques of marginal costing and in what ways you consider this technique useful in management accounting. So marginal costing, absorption costing, then there is one more concept called prime costing. These things come under the unit related to costing and cost accounting. Okay, and again this has come up. How about marginal costing itself? It has come up as such essay questions, long essay questions, as well as they have also been asked in short answer type questions also. So this is also a very important topic. In case you have not gone through, please go through. So coming back to our question, what is marginal costing? So what is marginal costing? It is the kind of costing that is based on the variable cost. Okay, variable cost of production. Variable cost of production. Okay, so marginal cost, it is the variable cost of production. So it does not include any kind of fixed cost. But when it comes to absorption costing, it includes both the variable and fixed. So in marginal costing, we only have the variable component, whereas in absorption costing, we have both variable and direct or fixed costs, okay, and indirect costs also of production. So all the different types of costing is included. So, but one thing that you should keep in mind is that this marginal costing, it is not permitted while we are doing financial reporting, but absorption cost is permitted. Why? Because we need to consider all kinds of costs while we are preparing cash flow statements, balance statements, and all those things. Okay, so in that case, when we are doing financial accounting, we should always consider absorption cost and not marginal cost. But when we are dealing with management accounting, then we can consider just the marginal cost. Now, some of the key differences between this absorption cost and marginal cost is that, first, as we said, marginal cost, it does not consider fixed costs which come under product or inventory valuation, whereas absorption cost, it takes care of both or takes into consideration both the fixed and variable cost. So marginal costing, it can be classified into fixed cost and variable cost, whereas absorption costing, cost can be classified as production cost, distribution, selling, administration. All those different classifications are possible. Now, the purpose of marginal costing is actually to show the contribution of this product cost. Okay, it is to show for the contribution of the product cost. And whereas the purpose of this absorption costing is to provide a fair and accurate picture of profits. Okay, so marginal costing is used to show how the production cost is what you can say contributing to our activities or our targets or budgets and all, whereas absorption cost, it provides a very fair and accurate picture of all our profits. Why? Simply because it considers all the different costing activities. Okay, so marginal costing can be expressed as a contribution per unit, whereas absorption, so marginal costing, it is kind of like a contribution per unit, whereas absorption costing, it can be viewed as the net profit. Okay, net profit that we are getting per unit. So it is a method, this marginal costing, it is a method of costing and it is not a conventional way of looking at costing methods, whereas absorption costing, it is used for financial and tax reporting and it is the most convenient method for costing as well. Now, there are a few limitations in marginal costing. Mainly, it stems from the fact that marginal cost, cost is classified into fixed and variable. Okay. Now, the problem with this classification of cost into just fixed and variable is that we cannot classify all costs that are associated with a business as just fixed or variable, right? With precision. There are a lot of other types of costs involved as well, like administration costs and all. So it is a bit difficult to classify perfectly all the types of costing into just fixed and variable, but definitely we have ways to circumvent it, right? Same way, marginal costing, it assumes that behavior of costs can be represented in a straight line. That is again as fixed variable. So much fixed, so much variable, like that. But and again, fixed costs are not included in the value of the stock of finished goods and work in progress as well. But at the same time, managerial costing, it has a lot of advantages also, like the utility as well. Some of them are like managerial costing is very easy to understand. Okay, now elimination of fixed overheads from the cost of production actually prevents the effect of all the varying charges per unit, and it prevents the carrying forward of a portion of this fixed overheads of the current period to the subsequent periods. So what happens is that cost and profits are not vitiated and cost comparisons become more meaningful. Now, the problem of over or under absorption of overheads is also avoided, and a clear cut division of cost into fixed and variable elements makes the flexible budgetary control system easy and effective, as well as effective, thereby facilitating a greater practical cost control. So marginal costing, like we apply it in the management accounting, and it is mainly used for our budgetary controls and cost controls and everything, and it helps profit planning also through break even charts and profit graphs. Comparative profitability can be easily assessed and brought to the notice of management for decision making. It is a very effective tool also for determining efficient sale or production policies, or for taking pricing and tendering decisions, particularly when business is at a very low ebb. Okay, so those are some of the utilities of marginal costing, we can say, and we also told about the limitation, right? Same way, some of the what you can say managerial uses of this marginal costing is: first, cost ascertainment. Okay, what is cost ascertainment? That is classification of cost into fixed and variable components. So what happens is that it becomes easy to ascertain costs for different components, and therefore it makes the reporting also very easy. Next is cost control. Okay, these are the uses of marginal costing in management. Okay, cost control. Marginal cost statements are very easy to understand, we said, right? Because of the bifurcation of cost into fixed and variable. So what happens is that the management can exercise much more control over the production cost and thereby affect the efficiency. So under this technique, management can study the behavior of cost at varying conditions of output and sales, thereby exercising a better control over these costs. Then the third point is on the decision making. Now, how does marginal costing help with decision making is that the main concern of today's modern management is profitability, right? Now, it is all about profitability for today's businesses. We all know that, right? So, it is important that the managers or the top management be able to select the best course of action for the most profitability. And this marginal costing through the contribution assist the management in solving such problems as well. Okay, like for example, we'll be much we are much better able to control our budgets and all these things through cost assessment and cost control contributions, right? So that is the what you can say the managerial application. So some of the few decision making problems that we can solve by marginal costing is profit planning. Okay, so what all we can do is profit planning can be made better. Then pricing of products. Then make or buy decisions, that is whether we should make our own raw materials or buy them from other suppliers. That is what is make or buy. That is just one example, okay, of make or buy decisions. Then product mix. So product mix actually you will learn about it while you are doing marketing management. Okay, so just if you have not yet followed through into marketing management, we'll definitely reach there once the subject is up close. But so the marginal costing can also help us decide on the product mix. Okay, so with that, I guess we have covered almost all the important concepts that is there in marginal costing. Let us move ahead. Okay, the next question is regarding cost volume profit CVP analysis. It is asking us to explain the interplay of various factors on profit and discuss the application of profit graph and list the assumptions on which this profit graph analysis is carried out. Okay, so what is cost volume profit analysis? It is a way to find out how changes in, so we said, right, in in marginal costing, please bear with my mistakes all the time I'm making, right? Sorry. So in marginal costing, we said, right, that cost is divided into fixed and variable, correct? So in cost volume profit, that is CVP analysis, it is a way to find out how this change in variable and fixed cost, they affect the firm's profit. Okay, cost volume profit. cost is the variable and fixed. Okay, how this change in variable and fixed cost will affect the profit of the firm. That is what we are trying to find out through CVP. Okay, and companies can use the CVP to see how many units they will need to sell to break even. What is break even? Break even is the point where company will cover all its costs. You will not make a profit, but you will not make a loss even. It is to break even. You can continue operating without any profit, that's it. Okay, or reach a certain minimum profit margin. Now, a few important factors or the interplay of what are the few important interplay of various factors on profit is, now the number of production units, right? Production per unit, the direct cost, value per unit, mix of enterprises and overhead costs, all these things interact. Okay, so how many units we can produce, the production per unit, the direct cost involved, the value per unit, mix of enterprises and overhead cost, all these things interact and what you can say interact and interplay on finally determining the profitability or the profit of the firm. Okay, the most basic factor that affects in the profit of any business is actually the number of what, the production units, right? How many production units are there? Based on that, those many units we can produce, right? So that is the what you can say, the interplay of various factors on profit you can write about. Now, what is profit graph? So profit graph, it is also called as a risk graph. Okay. Now, this risk graph or this profit graph, it is actually a two-dimensional graphical representation. Okay. So it has two axes and it displays the range of profit or loss possibilities for on an option trade. Okay. Now, the horizontal axis of this risk or this profit graph, that shows the price of this underlying security at its expiration date. Whereas this vertical axis, okay, it shows the potential profit or loss. Okay, the potential profit or loss is what is marked in the y-axis. Okay, so what happens is when we plot the price of this asset or this security with the profit or loss possibilities, then we'll get this two-dimensional graph called which is called the profit graph. Okay, so it is so what happens is that it will show us an idea or a graphical representation of our earnings or losses, okay, of the company in relation to its volume of sales. And this graph can be used to establish all the sales goals, analyze whether new products are likely to be profitable, or estimate the break-even points as well. Now, while we are preparing this profit graph or this risk graph, we take into consideration a few assumptions. Okay, the assumptions are that the CVP analysis, cost is again segregated into fixed and variable, and total fixed cost is assumed to be constant at all output levels. Okay, so the first assumption you can say is that we assume that the fixed cost remains fixed. Okay, it is constant at whatever be the output we are expecting. We think of the fixed cost as remaining constant. Okay, so cost linearity, you can say, it is preserved over the relevant range, and revenues are also considered constant per unit. And the next is that the business has a constant product mix and it only produces only one kind of product. So we are also assuming that the product mix is constant while preparing this profit graph or this risk graph. So as an efficient manager, the efficient manager should know, or the business owner should know, that these are the assumptions that have gone into while creating the profit graph, and they have to try to bring out the best results from the CVP analysis while they clear out of all these assumptions. Okay, because it is not always that your fixed costs remain constant, and it is not always that you always have the same kind of a product mix. It keeps on changes. Okay, so the next is the about the accounting concepts. Explain the various accounting concepts and discuss their application in preparation of financial accounts. Again, this we had created a dedicated video for accounting concept. There are 12 accounting concepts. Now, we can have an essay question like this, which asks you to explain all the various accounting concepts. Okay, so you will need to know all the 12, or you might get a short note question or what you can say, a part of an essay worth maybe 10 marks or so, which asks you to discuss or describe on a particular type of accounting concept. Maybe the going concern concept or materiality concept or something like that. Maybe one or two concepts in club together you might get, or a single concept alone. So it is very important that you study all these 12 accounting concepts while you go to for exams, because almost again all question papers I've gone through so far, at least one type of accounting concept they have asked. So maybe you will get a short answer type question or a big essay question itself, but please learn and go. I'll leave a link to that accounting concepts video, because there we have described in detail all the types of accounting concept. I'm not going into detail again here. Now, the next question is about what is a budget. Okay, and briefly discuss all the different types of budgets that will be prepared by a typical business concern, and discuss on the significance of budgetary control in modern organizations, and describe the control ratios that are used for this purpose. Again, a similar question which came up in a different term and examination paper is again asking us about what we understand by budgetary control, discuss significance in modern businesses, explain what are the steps for installing an effective system of budgetary control in an organization. So again, once again, budgetary control also we have been seeing multiple times. Make sure you learn about budgetary controls as well before going into your examination. Now, coming to this question, what is a budget? Well, a budget is like a spending plan, right? When we say what is our family's budget for this month, right? What we are trying to do is we are trying to make a spending plan based on all our income and expenses, right? It is you can say an estimate of how much money you will make and spend over a certain period of time, like maybe in a month or maybe in a year, right? You might have often heard your parents say, oh, we are out of budget this month, we've already used up our grocery budget, right? It is a good, in case you guys don't follow budget, I would strongly suggest you do, because then you will catch all your unnecessary spendings and you will actually try to start saving something. Okay, you need to have that realistic picture of how much you earn before you can wisely start spending and saving, right? Just a tip. Okay, so what is a budget? It is a way to balance the income and expense and financial goals for a specific length of time, you can say. A business's budget, you can say it is a spending plan for your business based on your income as well as expenses. It identifies your available capital, estimates your spending, and helps you predict your revenue, right? And it can help you plan your business activities and act as a yardstick for setting up all your financial goals. It can help you tackle both short-term obstacles as well as long-term planning, right? So we have right now in the market, we have a lot of budgeting apps. Okay, so or you can even use a simple spreadsheet or an Excel sheet to do your budgets. So usually big firms, they have their own budgeting apps and budgeting applications, whereas if it is a small firm, they'll generally maybe do it in an Excel workbook or so. So there is actually, you can't say that this is a correct way to budget and this is a wrong way. There is nothing called a correct way of budgeting, because what works for your business may not work for another business. It same goes with individuals as well, right? The way I budget based on my income, my situations, and my future or my planned expenses, it might not be the same for you. So definitely, even if you and me, we both earn same amount of money, the budgets we create for grocery or maybe for buying our favorite things or investing in something will be very drastically different, right? Yeah. So what is this budgetary control? This budgetary control, it is a financial jargon actually, right? It is a financial jargon, and it means for managing this income and expenditure. So budgetary control is just a way to manage your income and expense. So in practice, what it means is that regularly comparing your actual income or actual expenditure to what is planned, okay, the planned income or expenditure, to identify whether or not a corrective action is required. So budgetary control means, like if it is for, like, let's take the example of our homes. Our moms will be keeping aside a said percentage or said amount of money every month for buying groceries in the house, right? So after each purchase, maybe you went berserk and you bought 2 cakes in a month. Now your mom will start saying, hey, this is not in our budget. If you go start spending like this, we'll not have groceries enough to last us 3 weeks, right? So what she's trying to do over here is to try and impose a budgetary control. And what she's doing is she is comparing the actual income or the actual expense to what was actually planned. And if it is going out of control, then we have to limit on certain other things to bring it under control, right? Otherwise, we are going to shoot up our budgets. and that will have repercussions on all the other things that we had planned for that particular month, right? Especially people like us in India, middle class people, we definitely have this budgetary control, very close association with this budgetary control, right? So this process of controlling budgets, actually you can break it down into 5 steps. Many steps are possible, but at least these 5 steps you can break it down. Okay, so the first step is to establish the actual position. Okay, where do we actually stand financially? Then what we do is we compare the actual position with the budget. Now suppose, say, as per our income, what we have per month is, say, 5,000, or 5,000 is too less, right? Let's say 50,000, just why not? Okay, actually what we have is 50,000, but as per our forecasts for this particular month, maybe we have a big party coming up, there's a birthday party planned or something, we would need 60,000 rupees, say. Okay, so that is the budget we have planned for this month. Now when we compare the actual position with our budget, we see that we are short of 10k, right? 10,000 rupees. So what we will do next is we calculate the variances. And so we now check why there is a variance of 10k. Okay, then after that, the fourth step is establish the reasons for this variance. So naturally, variance. Okay, naturally we'll find out that this 10k extra has come up because we have planned a birthday party, right? Now the fifth is take action to exert control. So what we'll do now? Now we might cut short. Maybe we had planned on buying chicken and mutton every week. Maybe, I don't know. Or what else? Maybe we are ardent fans of having mozzarella cheese and making homemade pizzas and stuff. Okay, so we do it on a regular basis, maybe probably. So what we'll do is, since we have a 10k extra expense this month because of a birthday party, we'll do one thing. We will cut out all our chicken and all those things, chicken, fish and cheese and all, so that we can adjust and bring down this 10k to our acceptable budget. That's what we do, right? So that is the taking action to exert control. So this example is actually just to make you understand these steps. Okay, so at least these 5 steps you should write when we talk about the steps of budget controlling. Okay, yeah, so what else was there? Yeah, the different types of budgets was asked. Now a few of the different types of budgets include, we have master budget. Okay, we have master budget, we have operating budget, then we have cash budget. Okay, then there is a financial budget, then we have labor budget, and we have static budget. Okay, so these are the different types of budget. Then, yeah, what is the significance of this budgetary control? We said, right, we have to manage our income and expense. That is why we need budgetary control. So what are the significances of this budgetary control? First and foremost, when there is a budgetary control being practiced, it compels the management to think about the future, right? It forces the management to look ahead and to set out detailed plans for achieving the targets for each department, for each operation, and each manager, ideally, to anticipate and give the organization purpose and direction. It promotes a coordination and communication. It clearly defines the areas of responsibility. It provides a basis for performance appraisal. Okay, and a budget is actually basically just a yardstick, right, which against which the actual performance is measured. So control is provided by comparison of this actual results against this budget plan, right? So what happens with this control mechanism? It enables remedial action to be taken, okay, as these variances between what we have and what is planned emerges. It motivates the employees by participating in setting of budgets. It improves the allocation of scarce resources, right, and economizes the management time by using management by exception principle as well. So these are some of the few significances of budgetary controls. Now, what are control ratios, right? We have asked about what are control ratios and what are the control ratios that are used for budgetary controlling. So what are control ratios? Under a budgetary control system, the actual performance is always compared to budgeted performance, right? So that's to enable the identification of variances. Variances are where our budget is varying or differing from what we have, right? So when these deviations or these variations are expressed in terms of ratios, then these ratios are referred to as control ratios. That's it. Now, there are mainly three types of control ratios, okay? I'll just rub these out so that there is space here to write, okay? Yeah, so there are three types of control ratios. First is the capacity ratio. Uh, so that is the first type of control ratio. Next, we have the activity ratio, and then we have the efficiency ratio. Okay, so what is capacity ratio? It is also known as the actual usage of budgeted capacity ratio. It shows the relationship between. So this capacity ratio, it actually shows the relationship between the actual number of, let's say actual ratio, like for example, the actual number of working hours, okay, versus the budgeted value, okay. So if you're comparing between working hours, let's say, it shows the relationship between the actual number of working hours and the budgeted number of working hours. Next is the activity ratio. It is the number of, what you can say, it is the, so again, taking the example of, let's say, we working hours of employees or the organization. It is, let's say, as a standard, we might have set some number of working hours, right? So this number of standard working hours, that is equivalent to the work produced, okay, with respect to, or what you can say, versus the budgeted standard hours. When we take a ratio of that, what we get is activity ratio. So what you can think of it is as a ratio that measures the level of activity at which the business is operating. Then again, the efficiency ratio, it is a ratio that measures the efficiency of the firm's operation. So again, taking into example the working hours, okay, the efficiency ratio, you can be thinking of it as the number of standard hours that is equivalent to the work produced, versus, or expressed as a ratio or towards the what you can say, actual hours that is spent in production. So what capacity ratio does is it measures the capacity, okay, activity ratio, it measures the activity, and efficiency ratio, it measures the efficiency of whatever thing that we are budgeting, okay, with respect to the standard or the actual working hours or the actual value of that particular thing. So when we think about budgeting, we generally think that budgeting is related to only cost and cash, right? Financial budgeting. But it is not just financial aspects that get budgeted. Also, like non-financial things, like for example, the working hours of the employees or the number of units that has to be produced, anything and everything can be budgeted, okay. So budgeting is not just limited to cash, so please don't think of it that way. As managers, we need to broaden our vistas on what we think can be budgeted, right? It is not just the cash. So for this part of our question answer session discussion, we are winding it off, okay. There are a lot more questions to be discussed upon, but I don't want to extend a single video very long. So I hope this session was useful to you. We have much more questions to be discussed. I will release it in parts, okay, so that you can go through each video according to how much time is available to you, because we are having our exams, right, in the next 2 days. So all the best. Whatever we are discussing so far, they are also the important things that you need to revise before going into your examination. Please make sure that you are also studying whatever questions at least that came in your assignment as well, okay. And please do not worry and waste your time by thinking that, oh, I don't know, if a problem comes, I do not know how to solve it. Do not worry, you need not know that to pass or even get good marks in the upcoming term and examination, but you need to be strong in your concepts. All right, so all the best. See you in the next video. Bye.